DKE really traces its history back to 1950, where Dale K. Earhart, who was the founder of the firm, started managing money for other members of his family. He had learned investing techniques when he went to Colorado College after the war. He'd been a flyer in the South Pacific in World War II, came back under the GI Bill, and teamed up with Dr. Lewis Abbott at the Colorado College, and he was taught covered call writing techniques. And so he employed covered call writing techniques for his own portfolio and then for family members starting in 1950 and became quite successful. He'd sell a call option contract to another party where he would agree to sell stock that he already owned at a particular price above the market at some point in the future. And at that time, it was just a date agreed upon. And for that right, the buyer of the option paid him cash. So if the stock didn't get up to the point where they had agreed to sell it, he would just keep the cash. So it was a cash flow strategy. And he became, in fact, the largest option writer and market maker for options for AT&T stock in the country. Dale started his career in the Northeast, New Jersey, New York area, and then moved with his family actually to join with his in-laws who had settled in Venice, Florida, which is on the southwest Gulf Coast. So in 1966, he moved his family and began practicing there just as a manager for himself and for his family and a few friends. He became known as an investment guru of sorts at the time and was in fact invited to join the A.G. Edwards firm, who was opening a branch in Venice, Florida at the time. So he practiced with A.G. Edwards for a period of time and then was approached by a gentleman by the name of Bob James, who was forming a new brokerage idea in St. Petersburg, Florida called Raymond James and Associates. And so Dale accepted the offer to join the firm and started working within the Raymond James operation as a money manager. At Raymond James, he was their first money management solution for clients, and one of the things that they developed, which was a strong model that we see today, was creating a network of independent investment advisors around the country. And so they formed a subsidiary called Investment Management and Research, and Dale then supplied the money management solution to many of those firms across the country. At that same time, and this was in the 1970s, he started promoting the idea of using a fee only rather than a commission-based strategy. And so he felt that it was the one way you could be on the same side as the client. So he was a great pioneer in promoting that movement. He also, having achieved a lot of success himself, was able to loan some monies to Raymond James over time in those early days when they were getting started up. And fortunately, Raymond James repaid those loans with stock. So Dale became one of the largest shareholders of Raymond James and Associates and maintained that relationship up until the mid-'80s. The idea that the stockbroker was going to make money based on the number and size of trades that could be placed sometimes put them at odds with the client objective, particularly if the stock market was going down. The stockbroker was making a lot of money, and sometimes even more money when markets were going down than the client was making. And the fee, which is scaled based on the asset being managed, the fee would decline as well during times of market contraction, so that you were always having the same impact on your revenue flow as the client was having on their asset. So he felt that just lined you up with the client's objectives more closely. Dale was an early innovator and promoter and leader in terms of promoting fee-only investment management services. In the early 80s, Dale started thinking about his own succession plan, and his son-in-law joined the practice in 1980. He'd been an officer in the Marine Corps and started learning the trading techniques. It was also in the early 80s that I met Dale. I had been the director of finance for a corporation that Dale served on the board for, and he saw what I was doing with the personal computer as it was coming out about that same time. So the ability to do some sophisticated financial modeling was a greatly enhanced capability over the old mainframe and IT department structure that had been in place. And he saw, again, some real possibilities for that in the investment world, which was very much mainframe and terminal based at the time. So he asked if I'd be willing to join the firm, and I did in the mid-'80s. And at that point, started taking some leadership role in the firm. His son-in-law and I bought the firm in its entirety in 1987 when Dale retired. And we have been very technology-based, always employing cutting-edge technology ever since. And that was something that Dale saw as real important to the firm's own capabilities and capacities. In 1987, concurrent with his retirement years, just before his retirement, Dale made the decision to leave Raymond James & Associates and become independent. And so at that time, we became an independent investment advisor and also affiliated with another firm in Charlotte, North Carolina, Interstate Johnson Lane, who had a similar network of independent investment advisors. And so that continued to be our practice focus, and we were employing both the covered call writing strategy and a managed account program, which was just using the same stocks that we would select for the covered call writing strategy. So we had expanded to building equity portfolios at that point. One of the frustrations that we had with building equity portfolios was the volatility of the portfolio, the lack of the ability to get really broad diversification in smaller accounts. And it seemed that the investment research that we would buy wasn't really that accurate. We couldn't pin our future on any of the advice it seemed that we were getting. So we started doing research into perhaps using mutual funds and building portfolios of mutual funds that would target specific risk parameters that we identified as appropriate for the client. We ran into a problem with the mutual funds as well, in that as we would look at what they said they would do and what they actually did, there seemed to be a lot of drift over time. So we ran into a real problem of trying to construct portfolios of mutual funds that were available to the public at the time, because they just seemed to change their stripes all the time. And that's the same point at which we read some of the first research that came out from Fama and French, talking about the three factors of risk. And that was tremendously helpful in forming the portfolios, but again, we didn't have a good implementation strategy until we found DFA, which of course was related to the Fama and French research, but we didn't know that at the time. So we encountered the research of Kenneth French and Eugene Fama, and who were both at the University of Chicago at the time, and their research paper on identifying the factors of risk. This gave us a really good roadmap for portfolio construction, but we still had the implementation difficulty of dealing with the mutual funds that were traditionally available, because they seemed to keep changing the ingredients. So it's like we could come up with a really great cake recipe and somebody kept messing with what was in the flour jar. Shortly after that, we became aware of dimensional fund advisors and their family of funds that were based on and constructed to the concepts that were identified by Eugene Fama and Kenneth French. And this all of a sudden gave us a way to implement in an efficient fashion. So we formed a relationship with dimensional fund advisors at that time. In the mid-'90s, we built on what we had learned about portfolio construction and risk profiling and combined that with some additional skills in terms of managing clients of ultra high net worth, and we developed services for family offices. Those family offices gave us a tremendous additional set of competencies around working with collegial teams of professionals that these families had around them, working on philanthropic strategies with these clients, and also client education, because we found it was really important to the ultra high net worth family that their succeeding generations knew about money and how to deal with money and how to deal with advisors. And so we practiced for several years just honing those skill sets. The virtual family office that came out of this, we called it virtual because it was comprising investment advisors, typically us, and CPAs, and sometimes 2 or 3 attorneys, as well as the members of the family, and we would all get together rather than having an office someplace that you would call your family office. We got together under a set of protocols and met sometimes in person at a conference center, but sometimes on the telephone or later on we were using web conferencing facilities so that we could all share information, because we found the role of the team was important to always detect what was going on with the family, either changes in the family structure itself, births, deaths, marriages, divorces, or changes in their goals. They may have new or emerging philanthropic goals or educational goals. So we were always there to detect what changes were happening in the family system so that we could adapt their financial system to support that. So we talked about managing 3 forms of capital for these ultra-high net worth families. The financial capital was easily understood, all their stocks and bonds and real estate and companies that they owned. But we also taught them to think about their social capital, which was the time that they would invest themselves serving on boards of directors or volunteering time, or money that they would give to support charities, or even the taxes that they would pay. And then we also taught them to think about their human capital portfolio, and that each of them had portfolio management techniques, so that eventually they focused just on the family unit as one that could grow great human beings that could actualize in society in effective ways. And so that managing the human capital portfolio, getting the right knowledge, attitude, skills, and wisdom to the next generations became more important, and the financial capital became that supporting mechanism. So rather than these meetings on a quarterly basis that we would have with this virtual family office, and we've called them the Family Board of Directors or the Family Board of Advisors, we would, in the first few years, be focusing on things like return and taxes and those things everybody was used to. Later on, they were really focusing on who's doing what in the family and what can we do to help them do it better. That was an idea that I conceived in the mid-90s just from trying to identify what were some of the weaknesses in the traditional models, either the traditional single-family office, which tended to serve the first generation well, and the other generations got into a relationship with it where they felt like, I characterize it as they would just have to go beg for money from the trustees. And found that that wasn't really a very satisfying result, because you end up with generations who either suffer from extreme entitlement mentalities, or they just don't have any way to promote themselves in the world in an actualizing way. And so looking at what were the weaknesses, we tried to build a model that got away from not only those particular weaknesses, but it also was a lot more cost effective than having an entrenched staff that was designed to serve mom and dad, and then hopefully took care of the kids. And as the family evolved into cousins, people that hadn't grown up under the same roof, there were real dynamics issues that we had to deal with. So if we look back over time, we're always trying to understand ourselves, and we took an assessment of what competencies we had developed over more than 50 years. And so we got back to understanding that putting yourself on the same side of the client was very important, and Dale expressed that when he said we need to work for a fee only. We also understood that leveraging our capabilities through technology and tools and good strategic partners was very essential, and how to employ that. We understood how important it was to think about all the forms of our clients' wealth system, not just thinking about their money, because they're all interrelated. And if we don't think about them as interrelated, we can end up with problems in the family structure, and we would consider that not to have served the family well. And so looking at these core competencies, we built on that model and said that the things that we have learned would be useful, we thought, to other independent investment advisors. So we developed a business line that allows an investment advisor to delegate everything but their unique ability, which in most cases was developing new relationships with clients or keeping relationships really good with existing clients. And that we found that as we were studying advisor practices, they tended to, over time, as they would grow, become more managers of their own practice and of the human resources in their practices and handling the day-to-day activities, and less time on those things that were their unique abilities. So we said that there's probably a way for us to create a way for them to delegate all their back office activities, whatever they might like, to us, and that we could aggregate our economies of scale to provide those services to other investment advisors. So DKE Advisor Solutions grew out of that, and we are now offering those services to independent investment advisors that have a similar or almost identical mindset as it comes to the capital markets. So every advisor that we would work with would also qualify to work with dimensional fund advisors. We have had really good success in starting this. In fact, there are some firms like CEG Worldwide who we suggest everyone take some training there to understand the consultative investment advisory service model. They, in fact, have recommended to the people that go through that program that they should find a firm like ours that can handle those back office services so that they can focus on what's important. So we've been involved in making sure that we've tailored our services specifically to the tenets that they have also put forth in their programs. The independent advisors that will associate themselves with us will each be developing still all their services under their own brand. We're not trying to create an aggregated brand where they become part of some bigger organization. We still want them to maintain all the flavor of their own culture, their own branding materials, and all the reports and so forth that we do for them carry their brands and their logos. So they would open their accounts at the custodians that they're using, whether it's a Fidelity or Charles Schwab or TD Ameritrade. They would open the accounts for the clients, and we would then start making sure that the files were populated and everything was coded properly so that management reports could be created. We, in fact, work with the producer of the management reports and the data aggregator to help them design customized reports for our clients. We also can help them with portfolio design, with risk tolerance testing. In fact, we identify risk profiling activity that's beyond risk tolerance, so we're always looking at the need to take risk as being the primary determinant for a portfolio, but then the capacity of that specific client's financial system to accept the risk and their psycho-emotional tolerance to risk as being limiting factors. Can they stay disciplined through the market moves of a portfolio designed to achieve their needs, their risk needs? A small firm, it's like having 10 people in your back office, and we're just as connected as if they were talking to somebody on the phone next door. They're connected to our computer systems, they're connected through our phone systems. Everyone has a contact person, and so it's a very, very intimate type of relationship that's seamless in its operation. So the last thought, history is always in the process of being made, and we're always taking stock of where we are and developing new capacities, new competencies. And we're also looking to the future at all times to see what's coming down the pike that we ought to pay attention to. So I never feel that business gets to the point where it's set it and forget it, we've now got the model right. It's such that we always have to pay attention to what's happening academically, is the research telling us, what are better ways to communicate with clients, and always looking for some additional capacity that we can bring to the table for our ultimate clients. So our posture is going to be continually looking to see where we can adapt either new research, new techniques, new capabilities, new technologies to better serve the end client.